Look, I want to start this right at the finish line, because the latest news we're looking at today is screaming something that most people are completely missing. The analysis of these new reports indicates that a massive stock market crash isn't just a remote possibility. It's imminent, and I don't use that word lightly.
No, you don't.
The labor market has just flashed a specific, very dangerous warning signal.
It is the exact same signal that flashed right before the dot-com bubble burst. And it's the exact same one that we saw just before the 2008 global financial crisis.
Which is terrifying context. And here's the scary part that, for me, really seals the deal. The smart money, the big institutional investors, the hedge funds, they're fully invested.
All in.
They are all in. There's almost no cash sitting on the sidelines. So our mission today is to decode a series of, frankly, alarming new reports on the U.S. labor market and stock positioning.
Right.
We're going to explain why, despite the optimistic headlines you might be seeing about a soft landing, the data suggests the U.S. economy is actually deteriorating, and fast.
And this isn't just about the stock tickers turning red or your 401k taking a hit. It's about a precarious situation where a drop in the labor market, which we are seeing start right now, could trigger a massive sell-off.
Why?
Because there's simply no one left to buy the dip.
So, buckle up. This is a reality check for your wallet. Let's get into the first piece of evidence, which honestly felt like a bucket of ice water when I first read it. We need to talk about the Challenger shock.
Right. This is the latest report from Challenger, Gray, and Christmas regarding job cuts in January. And look, we see layoff reports all the time, but the numbers here are, quite frankly, historic.
Okay, let's break that down, because historic is a word that gets thrown around a lot. We are talking about U.S.-based employers announcing over 108,000 job cuts.
Just in January.
In a single month. To put that in perspective, that's a 118% increase compared to the same time last year.
And if you look at it month over month, it's a 205% jump from December. That is just a vertical line on a chart.
Those percentages are massive, but I think the timeline is even more telling. This is the highest total for the month of January since 2009.
2009, which, if you recall, was the absolute depth of the great financial crisis.
Right.
That's the comparison we're dealing with here. We aren't comparing this to a mild slowdown. We're comparing it to the last time the global financial system nearly melted down.
But there's a specific nuance in this report that really caught my eye, and I think this is where the real insight is. Usually in January, you have all these seasonal workers.
Exactly. People hired for the holiday rush working at Amazon, Target, logistics.
And a good chunk of them usually get kept on.
Precisely. In a healthy, growing economy, those part-time holiday jobs often convert into full-time roles. Employers say, hey, demand is still good, the consumer is spending, stay on board.
But this year,
we're seeing the exact opposite. They aren't converting, they are cutting.
It feels like a massive hangover. Yeah, the party's over, and companies are kicking everyone out of the house. So what does that tell us about the why here? Why are companies shedding weight so aggressively?
It's a simple, cold equation. Costs are rising faster than revenues. The media might tell you things are stabilizing, but corporate balance sheets tell the truth.
And what's that?
Demand is plunging. And when demand drops and costs stay high, wages, materials, debt servicing companies have only one lever left to pull to preserve capital. They have to cut staff.
And it's not just that they are firing people. They're not planning to hire anyone new either. I saw in the report that hiring plans were the lowest total for the month since, again, 2009.
That's the key context. This is a retreat. Employers are retreating. It signals a recessionary environment.
It's a pincer movement.
It is. When you see hiring plans evaporate at the same time layoffs spike, you're looking at a contraction, a pincer movement on the American worker.
It just feels like a massive disconnect, doesn't it? You turn on the TV and hear about a resilient economy, but then you see 100,000 pink slips in a single month.
That is the danger of relying on lagging narratives versus leading indicators. The news reports on what happened last quarter. This data is showing us the reality on the ground floor of the economy right now.
And that reality is the labor market is cracking.
It's cracking.
Okay, so that's the layoff side of things, the people getting the bad news today. But there's another layer to this, and that's the unemployment pipeline. We have to talk about claims.
Right. We have initial jobless claims ticking up, hitting around 231,000. But, you have to look closer at the unadjusted claims to see the real crack in the foundation.
Unadjusted meaning the raw numbers before the government applies their, seasonal math magic.
Exactly. The Department of Labor smooths things out for holidays and weather. But if you strip that away, normally at this time of year, unadjusted claims should be dropping. Instead, they jumped significantly.
By how much?
By about 20,000. That is a deviation from the norm that suggests fundamental weakness. But the real danger, the number that keeps me up at night, isn't the people filing for the first time.
It's the continued claims.
It's the continued claims.
Okay, explain that for everyone. What is the meaningful difference between an initial claim and a continued claim?
Think of an initial claim as someone entering the system. They're saying, I lost my job this week. A continued claim is a proxy for people who are still receiving benefits.
So they haven't found a new job yet.
They haven't found one. So initial claims tell us about firing. Continued claims tell us about hiring or, the lack of it.
And that number is surging.
It has surged to 1.84 million. And if you look at the unadjusted numbers, it's even higher. And here's why this matters so much. When continued claims rise, it means the labor market has become stagnant.
Stagnant.
It becomes what economists call a sticky labor market.
Sticky, that sounds unpleasant.
It is. It means people are falling out of the boat, and no one is throwing them a life preserver. They're getting stuck in the system. They aren't transitioning to new roles. They're just becoming long-term unemployed.
And historically, looking at the charts in our source material, this is the smoking gun, isn't it?
It is. If you look at the correlation going back decades, 1990, 2000, 2007, when continued claims start to trend upward like this, a recession follows.
It's almost 1-to-1.
Almost. And subsequently, the stock market collapses to reflect that economic reality.
It's like a domino effect. First the jobs get sticky, then the economy stalls, then the market crashes.
And yet, look at the stock market right now. It's behaving as if none of this is happening. We're near all-time highs. But history tells us that eventually the market always catches down to the reality of the labor force.
Gravity always wins.
It might take a month, it might take 3, but gravity always wins.
I want to dig into the mechanics of this meltdown a bit more. Because it's not just about losing jobs, is it? It's about the quality of the jobs that are left. We have this data on job openings, or JOLTS.
The JOLTS data, yes, this is crucial. Available positions have decreased to roughly 6.54 million. That is a significant drop from the peaks we saw a year or two ago.
Right.
But there is a sequence of events that happens in a struggling economy. A pattern that plays out almost every time. It's like a playbook for a recession.
Okay, walk us through that sequence. If I'm a business owner, what's the first thing I do?
Step 1, you cut job openings. You freeze hiring. You say, when Bob quits, we're not replacing him. We're seeing that clearly now. Step 2, you cut hours for existing employees.
And that's the hours indicator we're seeing flash red.
Yes. The average weekly hours worked are dropping. This is insidious because it doesn't show up in the unemployment rate. You still have a job, right?
You're not a statistic yet.
Yeah. But instead of working 40 hours, maybe you're working 32. Maybe your overtime is completely gone.
But that hits your wallet just as hard. Losing 8 hours a week is a 20% pay cut, effectively.
Exactly. It's invisible to the headlines, but devastating to the bank account. And this connects to the big picture of the U.S. economy. You have to remember, the U.S. economy is 70% consumption.
It's driven by people buying things.
So fewer job openings plus fewer hours worked equals less money in workers' pockets. It's simple math.
And less money in pockets means less spending at the store. You skip the vacation. You buy the generic brand. You delay buying the new car.
Which means reduced consumption. Reduced consumption leads to falling corporate profits. And ultimately, falling corporate profits cause the stock market to crash.
It's a mathematical certainty if the cycle continues.
It is. You cannot have rising stock prices with falling corporate profits for very long.
It's the cycle of life, but for an economic depression.
And we have to address this new normal argument. You hear people say, oh, stocks can only go up, the old rules don't apply, AI will save us. The analysis we're looking at argues strongly that the stock market has completely detached from reality. Job openings are falling, yet stocks stayed high. That gap cannot exist forever.
The market has to catch down.
It has to catch down to the fundamentals.
That catching down part is what sounds painful. And speaking of painful, let's talk about the setup in the market itself. Because it's not just that the economy is weak, the market structure seems incredibly fragile. The analysis brings up something called the Wyckoff Distribution pattern. Now, I know that sounds like something from a physics textbook, so let's break it down simply.
Right. It gets a little technical, but stick with me because it is fascinating. The Wyckoff pattern is a way of looking at market psychology and the movement of smart money versus dumb money.
Smart money being the institutions, the Emersons, the banks.
Correct. And dumb money, unfortunately, usually refers to the average retail investor, the person checking their app on their lunch break. The Wyckoff pattern tracks how institutions distribute their stock, meaning sell it off to retail investors right before a drop. Imagine a pump and dump, but on a massive institutional scale over months.
So where are we in this pattern? Are they buying or are they selling?
According to this analysis, the Nasdaq Q100 is currently at what is called the LPS, the last point of supply.
That sounds ominous.
It is the final level of support before the floor falls out. It suggests the big players have already distributed their holdings, they've sold what they wanted to sell to the retail crowd.
And they're positioned for a drop.
Exactly. But here is the real kicker, and this is about market liquidity. This is the part that scares me more than the chart pattern.
This is the all-in problem we touched on in the intro.
Yes. Fund managers are currently at their lowest cash levels in decades. They are fully invested. They've bought everything they can buy to chase this recent rally.
So if they're all in, that means their ammunition is spent? They have no dry powder left?
Precisely. And this creates a liquidity vacuum. Think about it. If bad news hits, like, say, a terrible jobs report next week and panic selling starts, who is left to buy?
Well, not them.
The smart money is already holding the bag or has already sold. They can't buy the dip because they have no cash, or they won't because they know it's crashing.
And if there are no buyers?
The price collapses, it free falls until it finds a level where someone is finally willing to step in. That lack of liquidity exacerbates the crash. It turns a 10% correction into a 30% rout.
Wow.
It's like a crowded theater where someone yells, "Fire!" but the exit door is the size of a cat flap.
That is a terrifying picture.
Ah.
So let's review. We have a deteriorating labor market, consumers running out of cash due to cut hours, and a stock market that is teetering on a cliff with no safety net.
Because the big players are tapped out.
So what do? We can't just leave people with doom and gloom. The analysis does provide a sort of survival guide.
It does. And look, none of this is financial advice, but these are the strategic moves the analysis suggests based on this data. The first rule here is defense.
Okay.
The clock is ticking. The analysis advises moving capital away from the sectors that are most vulnerable to a recession.
And which sectors are those?
Banks, technology, and cyclical stocks.
Wait, tech? But tech has been the darling of the market. Everyone loves big tech. It's been the only thing working for 2 years.
That is exactly why it's dangerous. It's overcrowded. Everyone owns it. If there is a rush to the exits, that's where the stampede happens.
Okay, that makes sense. And cyclicals.
Things like car manufacturers, luxury goods, travel, they rely on a strong economy. If the consumer is tapped out, those sectors get crushed first.
So where does the money go? If we take it out of Apple and Ford, where is the safe harbor?
The analysis recommends defensive sectors, things people need regardless of the economy. Utilities.
You still need to heat your home.
Exactly, even if you lost your job. Healthcare. You still need medicine. These are inelastic demands.
And there was a big emphasis on cash.
Yes, specifically referencing Jeffrey Gundlach, the bond king. The recommendation is a minimum of 20% cash.
20%. That's a lot of dry powder. A lot of people hate holding cash because of inflation.
It is, but the logic is twofold. One, cash doesn't crash. It protects your principal. If the market drops 50%, your cash is still there.
And two,
and this is crucial, if you have cash when the market crashes, you are the one person who can buy the dip. You get to buy high-quality assets at a discount while everyone else is selling in panic. It's about optionality.
there was also a mention of short-term treasuries.
Right. Safe, liquid, interest-bearing. A place to park money while the storm passes. You're getting a yield while you wait for the dust to settle.
Now, for the people with a stronger stomach, the pros, as the analysis calls them, there was another option mentioned, shorting. But we need to put a massive warning label on this.
A massive warning label. This is for high-risk tolerance only. The analysis suggests tactically shorting the major indices, specifically big tech.
Why big tech?
The argument is that the Wyckoff setup makes big tech the most vulnerable to a significant drop. But betting against the market is dangerous. As the saying goes, the market can remain irrational longer than you can remain solvent.
Right. Don't try this at home unless you're a professional. Shorting is how you can lose infinite money if you're wrong. But the message is clear. The wind is changing.
The wind isn't just changing. I mean, it's turning into a hurricane. We have this convergence of factors that we haven't seen since 2008.
Let's recap this perfect storm because I want to make sure this sticks.
Yeah.
We have historic layoffs, Highest January since 2009.
Yep.
We have unemployment claims rising and becoming sticky, people checking in but not checking out.
We have a reduction in work hours, which drains the consumer economy. And we have a technical market setup, that Wyckoff pattern that screams crash, at a time when institutional investors have no cash left to stabilize the market.
It is heavy stuff. And I know listening to this, it can feel abstract, just numbers on a screen. But we have to remember, these numbers represent people.
That is the most important part. When we talk about 108,000 job cuts, that is 108,000 families wondering how to pay the mortgage. That's anxiety. That is real-world pain.
And that anxiety translates into behavior.
Yeah.
It changes how people spend, how they save, how they vote with their dollars.
Yeah.
It's not just about whether your portfolio goes down 10%. It's about the stability of the entire system.
It is about livelihoods. And frankly, the media optimism we're seeing feels like gaslighting when you look at the raw data.
How so?
They're telling you the sky is blue while the storm clouds are already overhead. They want to keep the consumer confident as long as possible, but the math doesn't care about confidence.
So as we wrap up this deep dive, I want to leave you with a thought that really stuck with me from looking at all of this. We talked about the smart money being all in. They're fully invested.
Right.
The consumer is getting their hours cut and running out of savings.
It raises the ultimate question.
If the fund managers have no cash left on the sidelines to buy, and the regular person on the street is running out of money to spend, who is left? Who is left to keep this market up?
That is the multi-trillion-dollar question. And the silence in response to that question is what should worry you the most.
Exactly. The gravity of this situation cannot be overstated. We hope this deep dive helps you see through the noise, stay informed, keep your eyes on the data, and do what you need to do to protect your capital. Thanks for listening.
Stay safe out there.